Hello and welcome to the 2023 rate and housing forecast with Garrick Wordmuller, myself from Fresh Home Loan, brought to you by Fresh Home Loan, independent mortgage brokers that work for the people. A lot of great programs we have for home buyers and homeowners, from home equity lines of credit to reverse mortgages to zero down loans with no income restrictions. So, any questions about finance in California, I am your man, and I look forward to helping you. Moving forward, we have a lot to discuss. 2022 was, a pretty crazy year for the markets. We definitely saw the change we all knew was imminent in rising rates. And so let's take a look at inflation drivers and mortgage rates. All right, so we're going to start with taking a look at how inflation drives mortgage rates. And you can see here inflation, which is the orange line, and the blue line would be the 30-year fixed rate. We can see how the numbers kind of got skewed with this artificially low interest rate period, right? We called quantitative easing through the pandemic and the lockdowns. You can see you kept mortgage rates low, and then inflation. Springtime of 2021, we started seeing inflation go up, and then it became a real issue last fall, I'd say. And that's when we really started to see mortgage rates really go up. And one thing you'll notice is that once mortgage rates caught up with inflation, they both kind of settled back down a little bit towards the end of the year. Not a huge deal, but we did see the 30-year fixed, most people were quoting above 7, and it went down to a good 6.25 or something like that, just using kind of general mortgage rates of that time period. Now, when will inflation peak? One thing we will see here is that the summer of 2021, we saw really low numbers as far as inflation goes. And then in the summer of 2022, we saw much higher inflation numbers. And so that's how inflation really kind of got out of control. And you can see here when we compare year over year inflation, if we were looking at November of 2021 versus November of 2022, we are quite a bit lower as as the core consumer price index shows. So it does look like we do have a better handle on inflation currently. Then another big thing here is shelter costs. You can see here we have the apartment list rent year over year versus the consumer price index. And you can see housing just got really, really, really expensive. We don't see rents coming down. We don't see inventory coming down. Shelter costs, we do see lagging, but we have seen them peak and come down. And so right now, if we were to look at it, it's kind of like looking at a roller coaster where the people on the front of the roller coaster are starting to go down, but the shelter and CPI index that we're reading from last month or else the month before, right? It's still going up. So we're kind of at a curve here, and we should see real shelter costs coming down within the coming months, the beginning of 2023. So now I don't know if we really see this at the grocery store per se, but according to the core CPI index, prices across the board have come down for food, gas, clothing, and other factors outside of shelter costs, which do have a lag effect. And here we're taking a look. This is pretty interesting. We're taking a look at 30-year rates versus the 10-year Treasury spread. And normally, there is a correlation, right? And it's not exact. It kind of looks exact when you're looking at it from a bird's eye view here. But like historically speaking, the 10-year Treasury is usually roughly 2% lower than mortgage rates. What happened at the end of 2022 is we saw a much wider spread where the 10-year was around 4%, but mortgage rates were up at 7. And what happened here is mortgages have a servicing element, right? When you pay your mortgage, you're paying someone, be it, whoever it may be. But your servicer collects the check and then pays that mortgage, right? And what happened here is we saw no, right? We didn't think rates would stay at the 7% range, and they didn't. But as far as investors were concerned for mortgages, they did not see these loans. Most people are in loans 5 to 7 years. So you get 5 to 7 years of payments, right? Received, servicing. So if you're not getting that, basically, and once rates went from 3% to 7% in less than a year, we didn't see investors didn't see those 7% mortgages of having any servicing rate because people, if you bought a house at that period of time, um, you're really looking to refinance that rate as soon as possible. And so, therefore, there was no real servicing element. They didn't see these loans lasting more than 6 to 8 months or something like that, right? And that's probably true. And so there was like just mortgages were just more expensive. There was less value to them, to funding them, to holding them, et cetera. And they were seeing as a bigger risk due to the fact that rates were so much higher than they were at the beginning of the year. And then recession is coming. It hasn't been announced yet in the media and everything, but what we are seeing, and this is pretty scary, is credit card and other revolving debt has just skyrocketed since the pandemic. You can see where we were getting stimulus checks and all these good things, and then boom, as soon as all that ended, credit card debt started going through the roof. And consumer savings since May or June or so of 2021, the personal savings rate has just plummeted. So we do see definite signs that a recession is coming. Another indicator of a recession, and we've talked about this before, is when the 10-year treasury minus the 3-month treasury is negative. The 10-year treasury should be higher than the 3-month treasury. And when that happens, we can see it here. The gray bars equal a recession. And 100% of the time that has happened, we have headed into a recession. And you can see currently we are way below that. So it does look like we will see a recession very soon. Okay, here we see household formations, and normally there is household formations are kind of steady at around 1.7 million, and this is when people are leaving to start a new household, basically, right? Leaving mom and dad, et cetera, whatever the case may be, and starting a new household. And we did see that decline quite a bit as interest rates went up and as the market kind of softened from 1.7 down to 1.3 million households. But what we're also seeing is builders are really backing down on new housing supply. They do not want to overbuild, and so we can see total new housing supply is 1.4 million. Household formations on a little bit of hold, 1.3 million. However, we do not see this as a crash because inventory is still down. And once these numbers go back up to that 1.7, there's still a housing shortage. So, one thing that's pretty interesting is house appreciation has gone up 115% over the last 10 years. And it's gone up 39% over the last 2 years. So, what we're seeing here is a decline of about 2.5% in the housing market, but we are still having an inventory issue, regardless of where mortgage rates are. People need to live somewhere. And so we do not see signs of a major crash here simply because of the units available to live in. All right, so for the housing forecast, we're expecting lower inflation, recession like slowdown, incomes increasing to help affordability, a very tight inventory environment, and rents still expensive and rising. And we do expect to see low single digit appreciation for the most of the US with a pickup in activity than we are seeing right now. So there's a lot to look at with the mortgage rate forecast as far as global quantitative tightening, a lack of foreign central bank buying, and more debt to be financed. And then, we will see lower inflation, which typically leads to lower rates as well as recession. And so we're looking at the 30-year fixed rates moving closer to 5% in the first half of 2023, and the US 10-year Treasury going near 3% or lower. So it does look positive overall for housing and mortgage in 2023. Once again, I'm Garrick Wordmuller. Thanks for watching this. And any information, any questions you have, you can message me. you can call me, and I'm definitely here to help you out. Have a great year. Happy New Year, everybody, and we will talk soon.
Yeah, fresh home loan ink. You want mortgage rates without breaking your bank. Well, I got what you need. I'll keep it 100. The very best lender. We sell money, yeah. There's really no equal. Independent mortgage brokers that work for the people. I know that the pandemic's brought many problems. What we offer is better rates.